Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager and education coach here at Schwab, and this is managing an options portfolio. And the endeavor to manage an options portfolio is commonly an effort to balance one's exposure to price, time, and volatility, three big variables that can ultimately determine the success or failure of a portfolio of options trades. So today we're going to be talking about managing existing positions and adding new positions to an example portfolio, but while always keeping in mind those three variables, price, time, and volatility. Should be an interesting discussion, bit of a balancing act. We'll talk about a process for maybe accomplishing that, but before we can get to that, let me first of all say hello to everybody out there in YouTube. Hi there, Life in the Fast Lane, Kevin, Austin, Josh, Jeremy, Joe, Greg, Sharon, John, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation. Be aware that you're invited to join us in the live discussions. This is a Wednesday webcast series, kicks off promptly noon Eastern. We'd love to have you here in the live stream. I also want to issue an invitation. If you're not following me on X, please do that. It's the best place to connect with me in between these live streams. You can find me on X at Cameron May CS. But let's get into this discussion. Of course, as we do that, we have to first pause to consider the risks associated with investing. Risks are real, so bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so with that important information in mind, let's move on to our agenda for the day. Three items on the agenda, as there are each week. If you haven't been in this series before, we manage from week to week an example portfolio of options trades and try to learn along the way about this world of trading options. So the first thing that we're going to do is discuss the maintenance of our existing option positions. We're going to be making a change to one of those positions today, but we want to also observe how it impacts the portfolio's exposure to price and time and volatility. Then we're going to look at current market conditions as we plan to place another new trade in the portfolio. But we also, of course, as we do that, want to make sure that that new trade serves our hypothetical trader's outlook here for price and time and volatility as well. So ultimately, we're going to add a new trade using an example on the Thinkorswim desktop platform, but framing it within what might the trader think is likely to happen with the price on a stock, what do they think is likely to happen with time, spoiler alert, it's probably going to go by, and what's likely to happen with volatility levels. How do we pick a strategy that can serve the purposes of all three of those variables? So let's go right to Thinkorswim. Here's our existing portfolio of options trades. And the first thing I want to note before we start making any changes to existing positions is the current portfolio exposure to price and time and volatility displayed in our Delta, Theta, and Vega columns. Now, in this series, we weight our portfolio against the S&P 500. I'll explain how that functions in just a moment, but I do want to make a quick note before we do anything of our current portfolio. Delta seems like it's around 2287. Markets are open, so these values are going to change as we talk. Our current portfolio Theta is around minus 1996. And our current portfolio Vega is around plus 9262. So if you're not familiar with these portfolio Greeks, this is basically what this is telling us. When we're benchmarked, beta weighted against the S&P 500, our Delta column is just telling us, well, Cameron, as the S&P has moved historically, a portfolio like this may have made or lost a certain amount of money or a projected amount of money. And so when we see a positive number down here at the bottom, what this is telling us is that if the S&P were to rise or fall 1 point, this is a projected gain in the case of rising S&P, or a loss in the case of a falling S&P. So about $23 worth of exposure for a 1 point move on the S&P, which is a tiny little move. But bottom line, I can tell you right now, this portfolio overall is somewhat bullish. Our theta starts with T, so does time. This is our exposure to time decay right now. If nothing else changed, price didn't move, volatility levels didn't move. The only thing that we saw was the passage of time. Our portfolio is in position to lose about $20 just to the corrosive effects of time decay over the course of the next 24 hours the next day. Now, finally, we have Vega. That's our portfolio's exposure to volatility. As volatility rises and falls, that typically impacts the general pricing of options. And generally speaking, a projected profit, unrealized gain on our portfolio would be if volatility of the S&P were to rise by 1 percentage point, our portfolio is currently positioned to benefit by that increase in volatility to the tune of about $93. If volatility were to drop, we might lose in unrealized losses about $93. So there we go. Those are our current Greeks. These are quite important metrics for an options trader to understand because this is how much exposure we have to price, time, and volatility. They're all estimates, but they tend to be pretty good estimates. So this is how things currently stand. And this is due to the positions that we hold. So let's look at those positions. And overall, positions net are doing fine, except for Amazon. I think this was our trade from last week. As we click on the quantity, it can tell us, yep, November 13th was the time we took this trade. And this was a long call vertical. Bought the 205 calls, sold the 210 calls. We prefer for our stock Amazon to be above 210 as we move toward the 20th of December, which is 30 days away. And it hasn't been. Right now, we're at 202. Let's go look at what's been going on with Amazon. So here's our chart of Amazon. We entered the trade right back here earlier in the trading session. So during the day, that was looking like a pretty good trade. But since then, we've seen a relative collapse in Amazon prices, and we find ourselves right here, actually just above the previous resistance, the broken resistance we talked about last week. That may be acting as a new support. It's been holding up for about 4 days now. We'll see. But where we would prefer to be, these lines and these boxes, I just drew in just for a visual reference point. The 210 line just represents our short strike. The 205 line represents our long strike. What we would prefer here is to be up here in the green area. And we're not. We're down here in the red area. So we'd like to see a recovery here. A trader at this point, what might they be thinking? Well, how much damage has been done? When we bought this call spread, we paid the difference between $13 and $9.55, so it was a $3.45 investment, hoping that it would increase to a $5 value. A $5 wide spread theoretically has a maximum value of $5, a debit spread. Unfortunately, it's actually shrunk to about $2. So we haven't lost all of the value of this investment, but we lost a good chunk of it. So a trader might weigh at this point, well, do we hold on and see if we bounce? Or do we exit all or a portion of the position? What do you think? We have 30 days remaining. Was it 30 days? I don't think so. Was it? Yes. I guess it is 30 days. Okay. So these are the 20th of December contracts. Yep, right out here. 30 days to go. The first few days have been uncooperative. However, looks like we are sitting maybe at a potential support area. What do? There are pros and cons. We could scale out, have some realized losses, but let the rest go and see if we can get a recovery. We could leave the whole thing in play. We could get out of everything. I think for right now, since we're sitting right on top of that support area, we're going to keep an eye on this, but we're going to see if it breaks that. Okay. Yeah, Greg says the maximum loss is 3,700. Depends on the fill. If you were following along at home, maybe you got a little bit of a different fill. This one was actually filled at 345. So our exposure, oh yeah, 345. We got 11 contracts. I was defaulting to 10. Yep, you're right. Yeah, if you want to see the math on that, 345 times 11 contracts is actually about a $3,800 risk. Right now, we're down about $1,700. So still value in that trade. We're going to leave that one alone. Now, Salesforce and Google, though, very similar trades with one very different thing that might change the way that a trader might choose to manage these. Salesforce, I'm going to tell you, we're not going to do anything with this position. Google, we are. Okay, so Salesforce, we just own a long call. This was actually, it started as a diagonal spread. We closed out the short options, the short contracts of that diagonal spread. And so now we're just sitting on what's currently a pretty highly profitable long haul. Not as profitable as it was a week ago. If we look at our chart, you can see we had run up, we've pulled back. So yeah, last week we were sitting on much larger profits with the stock up there about $345. Now we're sitting down here at about $325-ish, about a $20 drop right there. So what are we going to do with these long calls? These calls don't actually expire for 121 days. So if a trader holds a long-term bullish outlook, maybe they just hang on to that position, which is actually just what I'm going to do. But we also need to be aware that just a couple of weeks from now, there's an earnings announcement. Now, another thing that we might choose to do is sell another short call against this. That could create some income, but it also can put essentially an upside cap on where we'd like the stock to go. And with that earnings right around the corner, maybe for some traders, they might decide, let's wait to sell a short option to diagonalize this trade until after that earnings. Because if the earnings go well, this stock has, well, the trade has unlimited upside potential. If they go poorly, yeah, that could erase some of our profits, maybe shove us into loss territory. Okay. It's even saying, could we just close out some of this and capture some of those gains? We actually have already, right? This started out as a larger position. We've scaled it back, just 2 contracts left. We've got lots of different things that a trader might do. I'm going to leave both of those contracts in play here. So the upside is if we get a great earnings announcement, if we bounce off this support, by the way, why is it a support? Well, for a couple of reasons. There's a previous high right back here that may be acting as support. Let's just draw that in there. But also, interestingly, and this might be a bit of a theme today, Salesforce went for a big run right here. Just took off right there about October 23rd. Raced up from, what was the low there, 283-ish to a high almost 350. Big run up. When there's a strong run up like that, for some traders, they expect some profit taking. And sometimes that might extend as much as 50%. At least some might expect that. I'm going to draw on a Fibonacci here. Where did we bottom out? Look at this. We came right down and just nicked that 50% retracement line. So yeah, raced up, gave back about half. And for some, they might see that as evidence that there might be a run about to happen again. We'll see. It's certainly not a guarantee that that's what's going to happen. But I'm going to leave that trade in position intact without making any changes. This, though, we're going to add to it. So with Alphabet, only 30 days remaining on this contract. This is a 165 call, not as profitable, but still profitable. Let's see what's been going on with Alphabet or Google. So here, oh yeah, we were even good in a bigger red day than when I was looking at a little bit earlier. But we started off with a diagonal spread, bought the 165 call, sold a 170. We've exited the 170. We've actually exited most of our diagonal. We're just left now with the remaining short call. Well, we closed out of that. We just have a long call left. So if a trader has an outlook for the next 30 days that the stock is likely to just run back up again, maybe they just hold on to that long call until some future date. What I was looking at here is maybe, since there's not an earnings announcement, unlike Salesforce, which has an earnings announcement coming up, Google's earnings is in the rearview mirror. So for a trader who doesn't like trading around earnings, or at least limiting the upside on an earnings announcement, well, what if we were to look at maybe selling? I don't know how much we get. Let's maybe look at a 180. Is there a 182.5 available? I'm going to go to the trade tab here and look at, How about we look at something like the 6th of December? We could even just turn this into a bull call vertical. Here's our position down here at 165, and we could sell an out of the money for the 20th of December. How about we look at that? Instead of turning it into a diagonal, we just make it into a longish vertical spread. We can maybe even sell the one. Let's look at that 182.5. That looks like that's trading for about 220. The 182.5 level is right. Let's draw in a line here. Again, just for visual reference, I'll get as close as I can. That's right up at those highs. So if we were to sell this call, well, if the stock goes up, that helps our long call. What we'd like to see here is our short call just in position to expire worthless, which would be the case if we're down, if we're still below 182.5. I think that's what we'll do today. Now, I want to ask, though, before we do that, what's the likely impact to our delta, our theta, and our vega? Well, if we sell a call, that's introducing a new bearish element. It's going to dial down the delta. It's going to make our portfolio slightly more bearish. The theta, we're selling an out-of-the-money call, that those tend to have time working in favor of them. So it's going to make our theta less negative or more positive. It's another way to look at that. Finally, our vega, when we sell options, sellers of options typically like to see falling levels of volatility, dragging prices down on options, or rising levels of volatility, increasing the value of options. Well, once we've sold, we typically like to see values drop. So this is going to reduce our vega. It's going to create more of a less positive bias for our vega. So there we go. So we're expecting probably a reduction in delta, our theta becoming more positive, and our vega becoming less positive. So let's go put it on our trade. And all those things might be fine if that's what a trader expects. Well, maybe they're just fine with being a little bit less bullish on Alphabet, getting time working more in their favor, and volatility's net still likely to be positive. Let's place that trade. Let's go to our trade tab. Go to the 182.5. Let's sell that call. And remember, we just have the one contract here. So I'm going to leave this as one short option for that 182.5 call. And it looks like our price, what do we have here? About 216. How about we say, yeah, you know what? That's okay. I'm going to leave that around 216. Let's click confirm and send. I'm going to try to sell that one call for a 217 limit. There is a commission to be paid here. Not a guarantee that we're going to fill. Anytime we use a limit order, there's a risk the order might not fill, but let's send that off. Markets are probably moving fairly rapidly. Well, not terribly rapidly, but let's send that off. See if we can get a fill. Here's our working order. 217 is all we're asking as a credit. The mark is at 219. Yep, so we've just filled at 218. So before making that change to our portfolio, we had a delta that was a positive 23-ish. It's now about 22-ish, so we've lowered that a little bit, made the portfolio a little bit less bullish. Our theta was around a minus 20. It is now around a minus 13. So time isn't working quite as hard against this portfolio as it was when we first launched this discussion. And our vega was around a plus 93. It's now around a plus 80. So we can already start to see the impact of the changes that we're making to our portfolio, to our exposure, price and time, and to price, time, and volatility. Now I'm going to hit the pause button. We're going to go look at the markets and add a new position to this portfolio in just a second. I do want to quickly review NVIDIA and Visa here. But I did notice that there's a survey that's been added to our chat for the live stream audience. So do me a favor, if you're in the live stream audience, click on that survey link right now and just have it ready to fill out for when we're done, when you can give me some honest feedback. What I'll say about the survey, number one, it's a really short survey, just 2 multiple choice questions, a comments box and a suggestion box. Only takes a minute to fill it out, but it's also always appreciated. It's never a wasted effort. Those survey results are sent right to me So I get to read through that data. I can read through your comments, and it always helps. All right. So thank you for doing that. Oh, and by the way, I was also remiss. Let me make amends here. I didn't say hello to Brent Morris for joining us here in the chats. Brent's going to be hanging out in the chat, helping answer any questions that I can't get to. Thanks for being there, Brent. You can also follow Brent on X at Brent Morris CS. Thanks, Brent, and thanks for reposting that survey. But let's get back to our current positions. Let's look at NVIDIA. So with NVIDIA, we sold the 135 calls, bought the 130 calls. This is another bull call spread, but unlike Amazon, which has been uncooperative, this one seems to be doing just fine with the stock around 145. We'd like to be above 135, and we're now at 145. So interestingly, right at break even. That's because we just placed this 2 weeks ago, and when we place that trade, let's look at NVIDIA. You might think, well, geez, it's $10 above where it needs to be. Well, when we placed the trade, we were right here, and now we're right there. So we're closer. We're working our way toward expiration. The stock is still in the territory where it needs to be. It just hasn't given us more breathing room net. So yeah, kind of treading water. Right now, up $55. Not uncommon to see that number flash around quite a bit when we're right close to a tipping point. But NVIDIA, we're just going to let that continue to work. It doesn't, if it just goes sideways for longer, if it goes up, even if it comes down, if it's above our strikes, we should still be in good position for our maximum theoretical gain. And then finally, we have our Visa bull put spread. Now this one we put on a few weeks ago. I'm going to click on this. You can see that we took this trade on October 30th. And it was almost immediately, realizing gains. And so we've scaled out of that. After a week, we'd already made more than half of our potential gains on this trade. So we took off half of the original 10 contracts. Another week goes by and it was still doing quite well. There wasn't a lot of gain left to be made. So we scaled it all the way down from 10 contracts to just one. Very limited risk exposure, very limited reward potential still. But when we got into this, we entered the trade for a credit of $1.30, difference between 325 and 455. Right now, we could get out of the remaining contract for probably around 20 cents. Never know unless and until an order fills. But I think with this one, we're just going to let it continue to work. It's our final move, our final position. But you can see how far into our green territory this is. Yeah, it's not been a great day for the stock. But even with a 1.5% pullback from yesterday's close, still a long way from putting us into significant danger territory, significant threat of entering, our maximum loss territory. So I'm going to let this last one work. We'll continue to talk about that over the next week or two until we finally decide if we need to pull the plug on it. But overall, current positions doing fine. Let's add a new trade to the portfolio. But as we do that, let's bear in mind our exposure. So here's where we stand right now. Our delta, we're a little bit less bullish than we started things. Our time exposure, a little bit less negative than when we started things. And as a matter of fact, it just bounced even a little bit lower still. And our exposure to volatility, maybe not quite as positive, maybe not quite as leaning toward an increase in volatility. But after that one change that we made, this is not how things now stand. So where does the trader want these to be? Well, here's some observations a trader might make if this is their current exposure to price and time and volatility. Let's start with price. We're bullish, net. If the S&P goes up at 1 point, this portfolio might be anticipated to see maybe another $22-ish in unrealized gains. Well, is that good or is that bad? If the trader is very bullish, they might think we need to dial that up. If they're starting to become bearish, they might say, I don't know if I want to be positive at all, and that can start to influence which strategy they choose to add to the portfolio. So let's go have a look. Here's what I would like you to do for me today. take a look at the S&P 500. Let's add another position for the December 20th expiration. And let's decide for our hypothetical investor here, between now and December 20th, do we think it's more likely that the markets, that the S&P 500 is it going up or going down from here? So that's our question. Do we think we're going to be higher or lower come nearly Christmas time? When I say Christmas time, kind of it's kind of a spoiler here. Yeah, we're about to enter the month of December, which has historically been one of the strongest months of the year. It doesn't mean that it's going to be in 2024. Time will tell. But let's say that our trade manager here has looked at, boy, the way things have been going, it's been a bull market for quite some time. And maybe the next few weeks are going to bring us the same. So they might already have that bit of a bias. And maybe they're looking at the time of the year as well and saying, well, it might be, it's kind of Santa rally time. We'll see if the odds play out again. But adding those elements together, maybe they've decided, let's dial up that delta. Let's increase the positive exposure to price. So, yeah, let's say that our objective is to increase, so this is going to be our objective for a new trade, increase that delta. All right, so that's decision made. Now, does this mean that this is the right thing to do? Nope, only time will tell. Maybe they increase it and S&P goes down, a lot of stocks go down, and the portfolio doesn't perform as well. That's definitely a possibility. But my objective here is just to talk through how a trader might make these decisions and then how they might line up strategies that are appropriate for the decisions that have been made. Next up is theta. Our theta is negative. Time is working against the portfolio right now. How about we just decide, let's increase that, meaning make it less negative. Let's get time working more in the favor of this portfolio. Now, there are trade-offs for doing that. It might just sound like, oh, that's always good, isn't it? Having time working for us, isn't that always good? Not necessarily. What that means is the trader's probably going to have to lean more towards selling options than buying options. And there are pros and cons to selling options, just like there are pros and cons to buying options. Buying options, time's working against those on a day-to-day basis, but they also have a lot of leverage if a trader can just get direction correct. Right? And volatility can play a role for either one as well. So it's not just, oh yes, let's be positive on time decay. That's one approach to trading options. It's not the approach to trading options. Greg says, Ben, decreased delta in the last session. That's good, because we should be seeing the pros and the cons of taking both angles to trade management. What we're ultimately trying to do is learn how to manage portfolios in just about any market condition. And so if we only teach one side of the coin, it's kind of an unbalanced education that we're delivering. And I think it would be coming up short of what we should be striving to deliver to our audience. All right, so we have Vega, volatility. Where's volatility headed from here? How might a trader make this decision? Well, they might look at a chart of the VIX. And I'll tell you, I think that an argument can be made in either way. Let's update our volatility line. This is just a drawing that I made here. I'm going to activate that drawing and pull it up to our current volatility levels. And looking over the last 12 months, has volatility been higher at times? Yes. Could it go higher from here? Yes. And if it does, the way our portfolio is currently structured, that could be beneficial. However, the bulk of the time, volatility levels have been lower. That could put a drag on our performance because we have a bias. We have a positive association with rising volatility levels right now. If volatility levels were to drop, and they certainly could, yeah, that could put a drag on an otherwise very carefully managed portfolio. So how about for this discussion, let's look to maybe decrease our positive volatility exposure. All right, so there are 3 decisions. We're about to go place a new trade, select a new strategy for our portfolio, but we want that strategy to do 3 things for this portfolio. increase the delta, make the portfolio more bullish, increase the theta, make it less negative and have time not working so hard against us, and decrease that vega. Because if the vega starts to slip, maybe that we can start to minimize that damage. So how do we do that? Well, here's a little bit of a guide that I have written for those that are trying to connect a trade objective with the trade itself. So when we're structuring that trade, here's this little guide will say, generally, if we want to increase our Greeks, this is what we would do. Increase our delta, open a bullish position. Increase our theta, or open a short position. Increase our vega, open a long position. Well, we do want to increase delta and theta, so open bullish, open short. But we're looking to decrease our vega. Well, it says to decrease, do the opposite of what the guide proposes. So our guide is proposing to open a long position. To decrease our vega, we'd open a short position. So that's a vote for opening bullish, a vote for opening short, and another vote for opening a short position. So what is a bullish short position? Selling puts. Yep. Or variations on that theme. So we are going to sell a put spread. We could just sell a put, just a plain old cash secured put. There are pros to doing that. There are cons to doing that. The pros are collect a premium. And as long as the contract expires out of the money, we should be in position for maximum theoretical gain. Obviously, a short option can even be assigned even if it's out of the money. We have to be aware of that. The con of just selling a cash secured put is the very large downside risk. If a stock doesn't go up and instead it goes down, it can go down and down and down and build and build and build the loss potential of the trade. So we're going to be doing a related strategy known as a bull put spread. So here's going to be our example trade. And let's see if we can get it to do all three of our things for us. But our example trade is a bull put spread. Let's use as our example today. I had a couple that I was viewing as potential examples before the webcast started. The first one was Meta. I'm going to throw Meta up here, and I want you to see why some traders might say, oh, this looks good, except one big potential issue. So Meta has been working its way higher, much like many of stocks out there. Higher highs and higher lows. Maybe our technical trader sees, oh, this could be bullish. That seems to be potentially appropriate for a new bullish trade. It's bouncing off its diagonal trend line. It's also bouncing off a previous broken resistance. Maybe that price ceiling may act as a new price floor. So technically, there could be an argument here for bullishness and structuring a bull put spread around this. What objection do you think some traders might have? Take a look at this. Why did I look at this and say, oh, maybe not, maybe not? And by the way, other potential qualifiers here is for some traders, they might look at liquidity as a big deal. Illiquid stocks tend to have illiquid options, and when you have illiquid options, the spread between the bid price and the ask price tends to widen, and it can widen dramatically, and it can make it more difficult to get into or out of options trades very efficiently, and it can also just dig one into a hole as we're trying to get into and out of the trades. It's just unfavorably priced. But Meta is one of the most liquid stocks out there. So that wasn't the reason that I eliminated this from consideration. Some traders would look at just the fact that this is a $560 stock. That means any long options come with the right to buy, if they're standard contracts, which Meta Platforms is. They have the right, they provide the right to buy or sell 100 shares at $500+ per share, depending on strike price selection. Short options can come with an obligation in that 500, 550, 560 range. That's a big obligation, a $55,000 obligation. Yeah, so for some, that price per share can be a disqualifier. It doesn't have to be, but I'm just saying for this scenario, how about we go to Walmart? Lower priced stock, maybe more comfortable for some traders, but let's see what it's been doing. It's been going higher and higher and higher, occasionally going sideways, pulling back a bit here or there. But it's been a great 12-month run for Walmart. Just came out of what appears to be a positively received earnings announcement and pushed up through some near-term resistance around that 85.5 level. Let's say that our trader likes the technical outlook for Walmart, at least through December 20th. Do you think retailers might stand a chance to do well in the holiday season? We'll see, right? Time will tell. But let's put on our bullish trade using Walmart as our example. So I'm going to go to our trade tab and let's get time working in the favor of this trade. And to do that, we're going to go out of the money. I'm going to look at let's look at this $85 put. Let's sell the 20th of December, $85 put, and that looks like that's trading for around $1. I like the nice round numbers. It makes my teaching easier. So let's say we're able to sell that for $1. Well, we could sell the put as I discussed, or at the same time, we might buy a less expensive option. How about we look at the 83 put? That was trading around 50 cents. Ooh, that's going to make my math nice and easy again. I didn't plan that. It's just the way it worked out. There we go. So by selling this $20 put, we are taking upon ourselves an obligation here. We're being paid conceptually $100, and in exchange, someone has the right to sell us shares of Walmart for 85 bucks. Now, they're comparatively unlikely to do that if the stock is worth more than $85. And if it goes higher, it becomes less and less likely that they ultimately require us to buy the shares from them. So we're just looking to hopefully just have that contract expire worthless, lets us off the hook, and the trader makes their gain. Now, the stock could collapse in price. And if it does, our $83 put, for which we spent 50 cents or $50, that gives us the right to sell these shares. If we get stuck with shares at 85, theoretically, we can sell those same shares for $83. So there's the $2 of exposure here. But for that, we're getting paid a net about 50 cents. So that leaves about $1.50 of total exposure. So let's map that out. The net credit of this trade, which is also the theoretical max gain of the trade, is 50 cents. $1 minus 50 cents. The theoretical max loss happens if we happen to get assigned at $85 and we exercise and sell for 83, that would be a $2 realized loss set against 50 cents originally collected. That would be a 150 loss. Yes, in this strategy, there's going to be less to be made than there is to be lost, but that's because the probabilities are in the favor of making the money versus losing the money. So let's put our trade on. Our $85 put, looks like we're not going to get quite a buck for that, but we'll see how close to 50 cents we can get. Let's click on the bid price to sell that put. And then we're going to go back up here to our $83 put. Hold down the control key on our keyboard and click on the ask price to buy that put. 47 cents. We might only get away with 45 cents here. I'm going to dial that down to just requiring a 45 cent requesting, not requiring. We might not get it. That would give us, oops. Let's see. How do we want to map this? It doesn't matter. Let's say it actually costs us just 55 cents here, giving us a net 45. Doesn't matter how it works out. Just whatever the net credit is here becomes our maximum gain. Okay. So let's click confirm and send, but this is only for one contract. How many contracts might the trader do here? Well, 155 bucks on the line per contract What if we did 10 contracts? That would be about $1,500. Let's dial that down to 10. There we go. $1,550 of theoretical potential loss. That would be about $450 of potential gain, assuming that we fill at 45 bucks. Let's click confirm and send. Selling these 10 verticals, $45 limit, 45-cent limit. If we can fill for that, 450 bucks that can be made, $1,550 maximum theoretical loss. There are commissions to be paid on that, so it trims into our potential gains there. So let's send that order off. See if we get filled. Yep, and we filled right at 45 bucks. There we go. Let me just check my math over here again, just make sure that I'm at least lining up a scenario. Yeah, that works out to 45 cents. That's just perfect. All right, and that's where we filled. So I want to talk about where this trade could head from here as we go back to our chart. Let's just draw in a couple of lines here. One at the 85 level, just to visually map out where we'd like the stock to be as we move toward that expiration. So there is our short strike. Our long strike is down here, 85 and 83. So we'd like to be up above 85 as we move toward expiration. That puts us in position to just have both contracts expire worthless, and we keep the 45 cents. If Walmart falls back and we're down below $83 as we hit expiration, now we're in the scenario where we might have to buy the shares at 85, sell them for 83, max loss. There's a third potential scenario. What if we slip down here to 84 or somewhere around there? Well, then we might get assigned at 85. We wind up having to buy shares. Our long contract just expires worthless, and we wind up just owning 1,000 shares of Walmart. So even though we might feel like we reduced that big obligation, we're still looking at an $87,000 obligation. Well, that's actually $85,000 obligation here that we have to realize if we get assigned and do not exercise, there's still that exposure. Okay? Now, that doesn't mean that we're just hung with an $85,000 loss. No, the shares still have value, so it depends on how much we could sell the shares for later. But there we go. Let's go see what this did to our portfolio exposure there. We wanted it to do three things. We wanted to, first of all, increase the bullishness of our portfolio. We were around 2189 for our delta. We've nudged that back up toward that original delta. We're now at really close, 2282. So that's check number one. We're aligning the trade selected with the objective for the portfolio. Theta, we wanted to increase this, make it less negative. Well, our theta is now down to minus 851. Time is not working as hard against the portfolio as it was. And our vega, we wanted to decrease that vega. We were at 80, now we're at 57. So that is check, check, check. Just the right strategy for the outlook that we had for this example. Doesn't mean that it's going to work out perfectly. What it means, though, is that the trader has selected an appropriate strategy for their outlook, which is what I want my audience to know how to do. So we've accomplished what we set out to do today. Managed existing positions, looked at the markets, placed a new trade, all while attempting to strike that balance between price, time, and volatility exposure. Hope you enjoy these sorts of discussions. We do this every Wednesday. I'd love to have you here every Wednesday. But our time is up. Time for me to let you go enjoy other presenters. But before you go, just remember that you have other resources available to you. Couple of suggestions that I would make. They don't cost anything, and it only takes a second. First is to follow me and Brent on X. You can find Brent there on X at Brent Moore CS. You can find me there at Cameron May CS. This is the best place to connect with your favorite presenters in between our live streams. A second suggestion that I would have is that you subscribe to our Trader Talks channel on YouTube. Just go down and click on the subscribe button right now. But YouTube is where we house all of our playlists for our previous webcast series, just organized by series. So you can quickly find the series of interest and start working your way down through those webcast archives. You can also join the live sessions right here. Thank you to everybody that's already clicked the like button. There's 151 people watching, 59 people have already clicked the like button. That's a pretty high proportion, I will say. Always appreciated if you would just do us the favor, every time you like a webcast, like that webcast. Click on the like button. It's a pat on the back to the presenter. It also gives their video a boost in the YouTube algorithm. So it helps it find a wider audience. And finally, there is a survey. So everybody, now's your chance. Brent's already reposted that survey a couple of times there in the chat. Thank you, Brent. Click on that survey link. Give me some honest feedback. I'll read through it. It always helps. Thanks for doing that. Everybody, I will see you next Wednesday. I'll look for you in my other webcast series between now and next Wednesday. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.